Thank you so much for joining us today. My name is Gabriela Farias, Head of Revenue for the Global Wealth Group. Joining us today is our partner, Cashbox Global, presenting a new growth note for Eurocentric banks backed by BBVA. If I could just have the three of you please introduce yourselves before we get started. Chad.
Hi guys, Chad Pope. I look after operations at Cashbox Global. Looking forward to sharing this opportunity with you this afternoon.
Thank you. And Jill?
I'm Jill, and I am involved on the side of investor relations and looking after the community, and so share information and keep everybody updated.
Great, thank you. And Andrew?
Hi everybody, Andrew from Cape Town. This is one of my babies that we're launching today. I'm responsible for growth, the growth in income notes, structuring them with our counterparties.
Wonderful. Well, we're eager to learn more about this particular note. I know a lot of work was put into it. So with that, I'll ask Chad and Andrew, please take it away.
Cool, thank you. Jill, do you want to go start?
Right, so just again to welcome everyone today to the session. We're going to be launching the BBVA European Banks Structured Note, which is a growth note. And again, we're excited to share this strong asset class with you. Just to note, Cashbox Global doesn't offer any advice. This is product information for education only and is based on the years of research that we have personally undertaken and actual results that have been achieved. We always encourage you to do your own research and due diligence. So with that, I would like to pass across to Chad. I mean, not Chad, Andrew.
Or Andrew and Chad.
Yeah.
Okay, thanks everybody. Right, the slide is up on screen. Pretty much rotation strategy into value. So as Jill mentioned, many of you will be familiar with the Cashbox income notes. This is a growth note. Chad at the back end of the presentation will be taking us into these sort of salient differences, which aren't too difficult to grasp, but they are important to run through. So let's have a little bit, why have we launched another bank's note? And I say another bank's note because in March of this year, we came out with this very, very similar structure with the same issuer, slightly different investment basket in terms of the names of the banks, but again, A-class rated banks in the investment basket. We look back 6 months later and 6 months hence, and we decided that banks are still offering great value propositions. And what we are looking to do is to capture, that first bullet point speaks to the initiative of capturing returns from various market cycles. There is a very, I think, a very concise rationale that we have put out that goes with this note. It's going to be available. So basically that explodes in a little bit more depth and explains a little bit more depth some of the deeper reasons. This is an informational webinar, so I'm cutting to the bullet points. Now, last year, it's tried to say that, looking back, it's quite easy to say that was the year of big tech, of the digital age, of those disruptive technologies that came and sustained and grew and became market leaders during the pandemic and the economic lockdowns and the drama that followed. Many of those disruptive technologies have almost become mainstream now. They're part of our lives. They're not disruptive anymore. We take them for granted. And during the recovery, which was basically led by the US in terms of the latter part of 2020 and into 2021, this big tech, this digital age, the futuristic, as I call them, disruptive technologies, have really taken the fall. And many, many sectors were overlooked. In other words, there was this momentum to growth, which is technically tech stocks and that space. But many of those sectors were overlooked. I call them the bridesmaids, and tech were the brides. And they've been overlooked, but they were great companies offering great returns, great management teams, solid balance sheets, quality blue chip companies. And we've certainly felt that during the latter part of 2020 and into 2021, there's been the so-called rotation into value. Last year, it was all about pivoting your business to survive. And certainly in the Q1, first quarter of this year, rotation, this word rotation, is on everybody's lips, in diversifying away the massive momentum shift to tech, in that it's been highly overweighted. Many of those stocks are highly overvalued in terms of their earnings. So people and investment professionals and investors themselves started looking for those sectors and those companies that offered great value at a great opportunities at a great value. And this is where you capture the returns. Certainly, we were very fortunate in being in the right space last year with due diligence. We were in that big tech space. And this year we started, going back to February and even earlier, we started looking at these overlooked sectors to see where we could extract value into our notes by using these undervalued, overlooked plays into investment baskets. And that also creates a great diversification story. Because last year, I'm banging on, it was all about the disruptive, the tech, the AI, the 5G, the e-commerce, the Zooms, you name it, artificial intelligence, robotics. We needed to also balance portfolios and balance diversification in terms of locking in those market cycles. Okay, so diversification is very, very important. I know Scott Picken is a great believer in it, and everybody should espouse that mantra. You need to diversify all the time. So where do we find that diversification? We certainly found it in banks this year, early this year. We launched a very similar note, and in all probability, that note will probably auto call or early mature sometime in September. It will only have run 6 months because those particular underlying banks have done so well. So we see further value, even though they've done well, we see further value in those stocks, and I'll take you through why. In terms of these market cycles, we've seen the market cycles in energy, industrials, financials, and raw materials, commodities. There have been some fantastic returns in the growth space for these type of sectors. So there you see financials, and I mean, if you can understand, why banks, financials were, they were at the head of the arrow when the bullet struck. If I can mix up analogies here, when the pandemic bullet struck, banks, interest rates around the world from a macroeconomic point had dropped well before March 2020, which effectively was the sort of bottom of the crash period. And banks suffer, in low interest rate environments, banks suffer. Their net interest revenues decrease, and they like to have high interest rates because it obviously brings revenue in on their funding activities. And in the March note, we actually included some high street banks as well as some investment banks. In this particular note, you'll see we've just included investment banks. It's quite important. We've noticed that, and it's been proved, investment banks are far more robust in terms of how they have weathered the pandemic storm of 2020 into 2021. The returns in Q1 and Q2 of these banks have absolutely blown the analysts away. And this is in a very benign, a very low cycled interest rates. Okay, these are European banks, but the same goes for American banks, same goes for UK banks. We are operating in very, very low interest levels. So these banks have done exceptionally well in this environment, in this benign environment of low interest. So why banks now? Well, one of the major provisions that banks made in 2020 was for bad debt, that their clients were going to go belly up, that businesses were going to go belly up, and they put provisions. In other words, they put money aside to basically pay off bad debt. And banks have this responsibility. They need to protect their balance sheets, their shareholders, their clients, and obviously their staff. And there's lots of examples of how this was done, but many of them over provisioned, and those over provisions are now coming back onto the balance sheet. So banks are looking quite healthy in an environment of very low interest rates. So therein lies, I believe, the magic. Everybody is saying, when are interest rates going to move? Because that will, in some instances, really affect the pricing of banks, the valuations of banks. And interest rates are really only going to happen when growth overheats. Now, we're seeing growth overheating in certain sectors of the economy, mainly the big tech space. But once pricing in terms of consumables, in terms of industrials, in terms of manufacturing, once that pricing starts going up and gets overheated, the central banks will start dealing with it. And that's called dealing with inflation. And this whole inflation and interest rates is pretty much a bogeyman to most people, to the man in the street. I mean, I don't particularly like interest rates because if you have debt, you end up paying more for it and there's less disposable, and your business ends up having to pay more, etc. So, but for a bank, it's actually quite a good thing. And led by primarily the US and the EU, there is this continued dovish approach to continue to support the economies of those areas. So in other words, the support for business, the Federal Reserve in America and the European Central Bank will continue at perhaps lower levels, but they are going to continue pumping money in, which means that from opportunity in the economy, opportunity in business in the economies as they unlock, is still going to be there. It's an exciting time to be invested. But as those interest rates come through, and there's talk about maybe another year of benign rates, maybe a little bit longer, maybe up to 2 years, 2023, that it's a great environment to do business in at these recovery levels. So by buying these stocks now, by buying these options to these stocks now, the bank who issues this product is taking a long-term view of saying, these are quality companies that we'd like to get our hands on at low valuations. And we're prepared to pay a great premium, 4% per quarter, as I'll take you through shortly, 16% US dollar per annum. We'll pay you that and roll it up as a coupon and pay it you out on certain conditions being fulfilled. Now, to me, what we are doing is we are getting in a typical value situation. So this is this rotation of the value. Even though these 4 banks that I'll go through quickly have done pretty well in the last 6 months, we feel that there's a lot of legs left in these to run a lot further and to higher valuations. Now, Chad will also take you through the stochastic in terms of what we need to do to achieve the accumulated coupon. I'm really more going to concentrate on this rotation into value. So hopefully I've dealt with why banks. They're undervalued from a perspective of there's still a lot of gas left in the tank for them to move. And we don't have to move very much in order to keep achieving these returns. Certainly, as I mentioned, the March issue of this bank's product is great empirical evidence. And if you'd like to have that shared with you to show exactly what we launched at and where those prices are now, you'll be suitably impressed. So if we could perhaps go to the next slide, Jill.
Andrew, maybe you'll touch on this, but you certainly have explained why banks. The banks that are involved in this particular note are Eurocentric. Was that intentional putting this note together, and is that something that you'll speak to as well, the actual region in which these banks operate?
No, great question, Gabby. I'll deal with that. I was actually going to deal with that when I'll go through the fact sheet, which is coming up shortly. Right. So in this next slide, just briefly, the difference of I've mentioned about the growth note. So our counterparty structure, who structures this deal with the issuing bank, in this instance BBVA, has issued 245 growth order call structured notes. In other words, over the last 5 years, we've had 245. So what's been the performance of these structures? Well, as you can see, there's only 91 active, and those are fairly new ones. In other words, there's a high probability that these notes don't run to term, and you'll see the term of this note. I'll show you that in the fact sheet. So in other words, they end early. The bank has almost designed them to end early because they don't want to keep paying these premium coupons to investors. Yes, sure, they want our money, but they want to actually extract themselves early from the contract. So in other words, your average duration, and this is average duration, is 3.3 years. I mentioned that we have a structure. The particular notes, the bank's note, which we launched in March this year, that's going to last 6 months. So some last a bit longer than others, but 3.3 years. So we always say to a client, if you are investing, invest for the term. And if there is a takeout, if there is a liquidity event by an auto call or early maturity, another name for it, you're looking at a much shorter time duration. And I think what's important here, Gabby, also, and everybody, is the difference between an income and a growth note is very simple. An income note pays out the quarterly coupon on a quarterly basis. Okay? It doesn't roll them up. It doesn't accumulate them. And that's really what a growth note does. It accumulates the coupon on a per quarterly basis. And when the terms and conditions to satisfy an early maturity are met, it repays the full capital and the accumulated numbers of quarters of coupons. So if it's run for 4 quarters, for example, it's the full 16% per annum, 4 times 4. If it runs for 2, it's 8, and so on and so forth. That's really the major difference. But Chad will also take you through a very simple but effective chart in which it shows you quite the different scenarios that can happen. Jill, if we could move on to the fact sheet then. Okay, so this is the fact sheet. We've spoken about BBVA. It's probably the 15th or 16th largest investment bank in the world. They have signed it off on their balance sheet. Please understand that the due diligence that goes into this note, they are writing it off their P&L. In other words, their profit and loss balance sheet. It has to go through their investment committee as well as their risk and compliance. There's quite a lot of hoops that get signed off before these products are put together. The coupon I've mentioned, it's 4% per quarter, and we call it snowballing. In other words, every quarter it snowballs, it gets added, it gets accumulated, and on the effect of the terms and conditions being met for auto call, it pays out all those accumulated coupons in one lump sum with your capital. Okay, so that is where the growth comes in. There's no distribution per quarter, it's accumulated in the product. The term is a maximum of 5 years. So as I mentioned earlier, we often say invest for the term, but you could be out in 3.3 years, you could be out in 6 months. And that will, and obviously your coupon size, your ultimate accumulated coupon size will depend on how many quarters this product has run. The auto call trigger, crucial. Okay, it's an early maturity. This is what triggers the early maturity. I'll just read it. 95% of initial value, starting at 6 months and their quarterly thereafter. So what that means is that those underlying banks, the reference basket in the next line, BNP Paribas, Banco Santander, ING, and HSBC, and I'll address Gabby's question. Those will have a price put to them on the strike date. In other words, in about 2 weeks' time, 3 weeks' time, we will have a strike date on those values. The bank, BBVA, is saying, guys, at 6 months and quarterly thereafter, if all 4 of them are at 95% or above their initial starting price, this investment ends. Simple as that. It ends, and the capital and how many quarters have accumulated will be repaid. So they're offering you a 5% discount. They're not saying it has to be exactly what it started at, 100%. They're giving you a 5%. Now, logic to me dictates, and I've seen many of these products created, it basically means that the bank is quite keen to get its hands on these particular shares because they bought the options to these companies. But what's very important is the behavior of those companies ultimately is what is important in terms of getting to 95%. You know, if we've got companies in there that are on a downward trajectory, then we're going to battle to make 95%. The fact that the bank's giving a 5% discount certainly means they're on an upward trajectory and they want this to end as soon as possible without paying out further coupons. So I'll run through the banks. I'll just run through capital protection. Capital protection, basically and Chad will deal with quite some detail. The bank underwrites this on its balance sheet for the duration of the 5 years. In other words, during that time, unless BBVA itself fails, goes insolvent, goes bankrupt, the capital is underwritten. It's only at the very last observation, the last day when it matures, that if any one of those 4 are below 50% of their starting price, then there's risk to capital. Okay, so it's one observation, the very last one. Any one of those 4, if they have more than half their balance sheet, then capital is at risk. Chad will explain it further. But just think about it. These are 4 major Eurocentric banks. Okay, their market capitalizations all run into the billions of euros. So for them to halve in value, it's not impossible, as we will always say, but it's highly unlikely. These banks are intrinsically woven into the economic wealth of their particular countries in which they are basically representing. So in as much as they're all international banks, that they've got operations in various parts of the world, BNP Paribas, for those who are not aware, is actually the largest bank in France. Banco Santander, excuse my accent, is mainly a Spanish-based bank. The ING Group Ing is Netherlands, it's in Holland. And HSBC, in as much as it has a very big Sino-Chinese Asian type of operation, it's actually UK-centric. So we're looking at France, we're looking at the UK, Holland, and the Netherlands. I beg your pardon, and Spain. So those particular companies, we've chosen them for size. They're all investment banks. These are all the investment banking side. So they're not just high street banks like a Wells Fargo in the United States, which would just take in deposits and lending. As I mentioned, investment banks have been shown during the pandemic of 2020 to be far more resilient, and the earnings that they're coming out with in Q1 and Q2 of this year, absolutely blowing analysts away in terms of what they've done. So they can only be in a great position to benefit from increased interest rates in the next, certainly when they come through in the next year or two. We go for size. Size does count in terms of when Cashbox structures something. Not only are these household names, but the very size of their businesses are robust enough, we believe, for them to halve in value would be endemic of a major collapse around the world. Not just of the bank, not of the banking system, but of the economic system. You know, if we look at 2020, what the behavior of banks, and on page 3 of the fact sheet, you'll actually see the charts of each of those banks for the last 5 years. It's in our fact sheet, you'll see that. They all behave, but they've all come back very, very well. Central banks, after the financial disaster of 2009, 2010, they can't let, central banks will not let, I believe, these large, intrinsically embedded financial institutions in these countries collapse. We've seen it before. We've seen it in the UK, where the UK government has stepped in, has lent support. Maverick banks, small banks, I won't call them hole-in-the-wall banks, but these banks have to have a minimum of A-rated, tier 1 rating. What I mean by that is that the 3 major credit rating agencies, Fitch, S&P, and Moody's, have to rate these, and they have to pass muster of at least an A-rated bank. Also very interesting, and it is a moving target, is that I've supplied to the investment committee of the global marketplace the sort of 52 and 56 week moving average in terms of what are the 30 largest brokerages have to say about these banks. It's quite interesting. And every single one of those Wall Street and UK and European brokerages is pointing to the fact that all 4 of these shares in 52 weeks, barring something that is left field that we don't anticipate, maybe another pandemic, as what happened in 2020, will be well above their current prices. If you look at the buy orders versus the hold versus the sell, everybody's accumulating these value plays at the moment. So this is a great opportunity to get in at the right valuations and to extract that value in a note. I always say the investor through the note does not hold those shares. Neither does the bank, quite frankly, the issuing bank, BBVA. These are options. This is what the bank will turn into shares at a point. It can turn them into shares at a point once there's an order call. So fantastic banks, great opportunities. The market consensus is that they're good accumulates in terms of building into a portfolio. We're using them in investment basket. We've got a 95% auto call trigger, so we don't have to be 100%. So in 6 months' time, that takes me, I think, to early January. This investment, as long as those 4 companies are within the range of 95% and above of their starting price next month, will end. And it'll be 8%. I actually like these things these notes to run on as long as possible, because 4% per quarter is a great coupon with capital protection underwritten by such a great bank. Okay, Joel, if we could perhaps move on to the fact sheet. Thank you. This is, you may have seen this before. This is the fact sheet that we put out. It's very, very simple. I'd rather concentrate on the right-hand side. Key information: we've got a short subscription period. This is not an open-ended opportunity. It's available until the 27th of July. The strike date is the 28th. In other words, the strike means they take those prices of those 4 banks and we lock those in. and we've got to get 95% and above from 6 months onwards. The issue date, that's just another word for start date. That's when it actually kicks off. So the 4th of August, it actually is, we live tracking. First, there you go, the first potential maturity is on the 28th of January. So this could be a short, in and out, but a great 8% return. Thanks for coming. Final observation, 5 years out, if it runs to term. We don't believe it's going to run to term. I certainly don't believe, not just because of the 3.3, but I think of the way this has been manufactured within the basket. Pretty much to the left-hand side, there your credit, in the center column there, your credit ratings I spoke about, very important. Your auto call opportunities, we've run through that. And again, a great basket of banks that are world leaders, quite frankly. And then moving to the next slide. This is quite important. It comes up with every note in every fact sheet. This is the certainty and predictability of a structured note. It's a contract underwritten by the bank, so it has to commit to dates and payment dates, etc. So your first observation for maturity, which will get you your coupons out, is on the 28th of January. The payment would be from the investment bank, if it auto called at 95% and above on your right-hand column, would be on the 4th of February. So yeah, in February, you could be having a great conversation in terms of what I do with my 8% and my capital again. If it doesn't happen, if it doesn't auto call on that date, then quarterly thereafter, per this schedule, will carry on running right the way down up until if it does last. And I think what's important, the very, very last final observation, as I mentioned there, your capital protection. So capital is protected during term, but should any one of those 4 stocks breach 50% of what they started at, then capital is risk. But I'll let that for Chad to discuss. So during term, just for a quick discussion, if one of these shares went up and down below 50, your capital is intact. What we are interested in is making sure that we get to 95% or above at any one of those dates, and the investment will end. And depending on how many observations you've gone down, you will accumulate all those coupons and it'll be paid out in one lump sum. I think that's me in a nutshell. Not for Chad to sort of take you through some of the next slides.
Cool. So, Gabby, as you know, we are operating in a different space now. The traditional structured notes that we've done before have all been income generating and income producing per quarter. What we're doing in this space now is we're looking for a period of time where we're going to be in the money, and it's always above the auto call level. So in a graphical form, this example shows a 5-year potential, which would give us our 20 quarters. And in this example, the auto call has been set at 95% of the start price. And you can see from the dotted line, it's available from Q2, which is the similar structure to the note that's available now. In this example, we've chosen a 5% coupon. And what would happen in this case, we would start at 100% of the value of the shares at the start price, which would be our strike price. And the products would start to run. Now, typically, lovely products and investments that banks have proven to be, and the value that these show, there should be a steady climb in value. And if that was the case, it could be that at Q2 already, the stocks have risen slightly and they're above 95%. It would trigger the auto call. The 2 quarters, the 5 plus the 5%, or in this case, in this product, 4 plus 4, would be added together, and then all the capital is returned directly to my platform. So it is possible that this product that Andrew's shown us and has structured could potentially already auto call at Q2. But let's say the stocks drop, and we'll ask Jill to open up the next slide. And let's say they're not at 95, they drop slightly, and sometime in the future, Q4, Q X, whatever it is, as long as we're above the 95% at an observation from the time the auto call is available, the product will close out. So we don't need stocks that are going to shoot the lights out, Gabby. We're just looking for steady, predictable income or steady, predictable stocks. They could stay at 100% of their start price. I mean, they could just go sideways. In fact, as Andrew said, they've actually discounted this. So the stock's going to drop by 5% and the product will close out. So what this has done is this has told us, let's go back and look in history and understand why the bank wants to do this. And the bank wants to do this because they're looking for stocks that they'd like to get their hands on. So as you've seen before, four options are put into that basket. They use our money to buy those options. They pay us a quarterly growth coupon. And at some time in the future, when those stocks are at a value that they want to take over, they can then swap those options into direct stocks and go and create value for themselves. So what do we want to do? We want to make sure that we have stocks in this basket that are going to be above the order call trigger at some point in time. So to your point earlier, across the 245 products that have been issued over the last 5 years, 154 have all auto-called as expected. The other 91 are still in their process and being activated. So every one has matured as designed, and the average time period has been around 3.3 years. But because of the value play in this particular basket, it's quite possible that we're going to auto call in 6, 9, or 12 months, more than likely 6. Take our coupons, take the growth, and go again. So for everybody's input, the next slide is important, because what happens if that does not auto call, right? Now, it hasn't happened, but it's prudent to know what could happen, right? Let's say those options remain below the auto call level for the balance of the product's life. As long as the worst performing share is above 50%, we will get our full capital out. And that's the last level of protection that's built in. So as long as they are not less than 50%, Andrew's often called that the floor, and then the ceiling being the 95, my full capital comes out. Do we want that? No, absolutely not. Nobody wants to go into investments and get your capital back. And that's why the share and the understanding of those shares in your portfolio is so important. So you'll notice just now we start to chat around dividend yielding stocks, etc. You would often put banks into dividend yielding stocks because they are steady and they're predictable, and they should generate a 5-6% a year. So instead of going for a 5-6% through this product for the same types of stocks, we're able now to offer a potential 16% for the year should it run for a year. So not impossible, highly, highly unlikely. And this is why institutional investors, pension funds, it could be high net worth family offices, etc., would invest in a product like this. Thanks, Jill. So the risks, obviously, to consider the underlying stocks, and Andrew's gone at length in understanding what those are. The issuing bank, you want to contract with a strong bank, and as Andrew has shown, these are probably this BBVA bank is probably about the 15th largest in the world. Decent balance sheets, well-run business, and a lot of work has been done in understanding that this issuing bank is going to be around. Early exit. So as Andrew said, if it is that you need to get out of this investment, we would have to find a willing buyer, willing seller. So please go into the product with the full term duration potential in place. So it's not money that you're going to need next year. While we're saying it's highly likely to mature early, be prepared to put the money in case it needs to stay in. Thank you, Jill. And then very important, we work in a highly regulated environment. An investment bank will only deal with a regulated platform. So as an investor, you fund your platform, you instruct your platform you'd like to go into the product, and off you go. As Cashbox, we work for self-led and motivated investors. We create a product together with IDAD. So this is where Andrew and IDAD get together. They have a look at products for the future. So what might be an opportunity in 6 months? is what they would decide, for example, and then put something forward. So they've taken a great view on where the market is right now and where they want to go. The investment bank then decide, okay, we'll do forward and back testing, as Andrew said, because they're going to issue this product off their balance sheet. They need to make money, and that product has to work as designed in order for everybody to want to do this again, of course. And then, as Jill said earlier, we're not in the advisory space. We produce amazing products. If you want to discuss this further, or your advisor to contact us, we gladly do that for you. And here it lives a highly regulated environment and a lot of convenience. So, yeah, amazing product, and you have a platform to operate off. Where would this fit into a portfolio? Of course, we can typically get 0 for cash in a bank. We can go for options. We could have a look at properties, retail notes, etc., etc. What's really nice about this growth asset is we've got predictable income in our normal income notes, and then we've got growth assets in the growth space. So if it is that you need income, that's great. We could do income products. If it is that you like growth, which typically compounds and builds growth at a much higher value, off you go. So if we were looking for an income note based on banks, for example, Gabby, maybe we would get, 3% a quarter. But because of the growth element and not actually handing out money through the life of the product, we can get a slightly higher coupon. So nice to have a portfolio of structured notes doing slightly different things. And in this space, again, we're going after growth. Thanks, Jill.
I love this slide, Chad, just to comment. I think that it just shows the true value of diversifying your portfolio, even within a structured note asset class, but diversifying within the indices or the growth or returns space, and how that fits into your portfolio.
Absolutely. And I love property too, and it has its space, right? So here we can get a decent spread. We can do different currencies. You can do stuff across continents. Yeah, it's really helpful. And in this, a little bit of everything I enjoy, and the flexibility of a platform to do that is important.
Absolutely. So thank you so much for that overview, and I think you painted a very clear picture for what the difference is between an income producing note and a growth note. I have looked at strike prices for these four banks, and they have been performing quite well over the last 6 months. I know you can't guarantee anything, but what is the kind of thumbs-up opinion that this will be an auto-called growth note within the next 6 months?
Andrew?
Gabby, I think that's your proverbial crystal ball problem, if I can call it that. I think what we try to do, and I mentioned that we did some empirical work with some of the largest brokerages, probably 30 across mainly Wall Street, because those brokerages operate worldwide, but the premium ones sit in New York. And of those 30, pretty much, when I say pretty much, 100% of them are suggesting that those 4 companies, their current valuations, their current prices, will on a moving 52-week average will be higher than certainly what they are now. In some instances, we're talking not just 1% or 2%. These are growth. These are cyclical stocks. They don't shoot the lights out. Banks are not usually bought in a portfolio for growth. They're bought for dividend cover. They're bought for stability. They're bought for a steady Eddie approach to your sort of faster, frothy stuff. So for 30 odd brokerages to align themselves and say, we're accumulating these companies because they're great companies at a good valuation. That's for somebody putting them into a direct portfolio. So, it makes sense that, as Chad said, one of the largest investment banks is prepared to pay a great premium and hopefully get out early in their instance at 6 months and quarterly thereafter. So the view is, there's a lot of think tank sort of propeller heads going into this, if I can call it that, without being disrespectful.
What's above your head?
Yeah, a propeller. But certainly within that period, I would suggest we're going to see, if you look on, and you're not privy to it now, but when you see the fact sheet, if you look over the last 5 years, there's a graph of each of those companies. And yeah, they all took like everybody, they took a bit of a smack in March 2020, but have a look at them since then in this low inflation environment. And when inflation comes, they're just going to take off even more. So it's very positive, and I think that's what these brokerages are factoring in, that these are slow growers, if you want to call it that. But as Chad said, we don't need to shoot the lights out to generate these accumulating coupons.
No, exactly. I mean, with the 95% auto call, and that's why I asked, right? It's a very achievable target in my mind, and based on everything that you've presented. So just anticipating when you would actually see that capital returned and those returns realized. Yeah. Well, so your first opportunity contractually is at 6 months. And let's say, for example, one of those banks isn't at 95%. Let's say 3 are and 1 is not. Then it will roll over to the next quarter and the next quarter and the next quarter. At that observation date, all 4 need to be at 95% or above. Subjectively, if I look at the metrics, I would say this, and this is a personal opinion, having done the research, I would say that these banks, in a rising interest rate environment with inflation coming in, I would say this could potentially, like the one we're looking at from March at 6 months, it could anywhere between 6 and 12 months. So it could be one of those short-term opportunities, but a great coupon to take away.
Cool.
Chad, you were going to mention something.
You were worried about your speaker, your mic. I didn't get that. Sorry.
Oh, you were going to mention something, and I believe I cut you off. So I just wanted to ask.
What's incredible, Gabby? So as Andrew said, a lot of people would put banks into a portfolio for dividend yield, expecting a 4 or 5% per year. Isn't it incredible, by using the same banks in a slightly different setup, you can take exactly that now and multiply it by 3 or 4 times for an annual income, which makes this quite remarkable. And that's why Andrew's been offering these kind of products into family offices for the last 30 years. He doesn't look at, he tells me it's only 40. And yeah, with great success. So we're very positive and delighted to add this to the community.
Absolutely. And from what I understand, the appetite for this note is already quite large within the Cashbox community. Now it's just seeing what who else might be interested prior to the strike date on the 28th of July.
Yeah, so fantastic.
It is proving itself already popular, which is great.
And then Gabby, we'll be collecting up until, I think, the week just before. So when they say strike date, everything has to be in and clear and done. So you'd have to decide then on the collection period just to make sure that we make the final cutoff time. Yes, this will be on our platforms available for investment until Friday, 23rd July. So next Great. Friday. Yeah, sounds good. Thank you for letting us help. Have a wonderful further and a great weekend. Cool. All the best. Cheers.
Thanks, Gabby. Cheers.